premise for Skeena Gold and Silver is really based on our flagship asset, SK Creek, which is a past-producing, underground, high-grade gold and silver mine that was previously owned and operated by Barrick. Barrick placed it on care and maintenance in 2008 during the global financial crisis, and we started work on this asset in 2017. To date, we have put out a significant amount of work. We have advanced the project, and we're at the point now where we can say that we are reconceptualizing SK Creek as one of the highest grade open pit projects in the world with initial production in 2027. I will be making forward-looking statements, so you are duly cautioned. And at the highest level, with the investment thesis, there are so many tier one attributes that make SK Creek an incredible project. Firstly, on the production side, we are targeting 450,000 ounces of gold equivalent metal per year in years 1 through 5. That is very, very sizable production coming out of a significant reserve of 4.6 million ounces of gold equivalent metal. This is backed by a robust grade profile of 5.5 grams per ton gold equivalent, again in years 1 through 5, which is approximately triple the global average for open pit gold mines. So that in itself makes this asset incredibly valuable, but there is so much more to the story. The costs are incredibly robust, bottom of the industry cost curve. This will be a significant cash flow generator. At spot prices today, we'll be generating about $800 million in after-tax free cash flow per year in years 1 through 5. If you're an EBITDA person, that's $1.3 billion in EBITDA per year. There's a significant silver component, hence I'm speaking on the silver panel, and we are fully funded to see this project through to production. So one of the biggest milestones in 2024 was the announcement of a financing package with Orion Resource Partners for a grand total of $750 million US, which is about 1 billion Canadian, against a projected initial capex of $713. The equity component was the smallest piece. There is a gold stream for $200 million, which we are drawing down on this year in tranches of $50 million to fund the development activities in 2025. There is a senior secured loan component with a coupon rate of SOFR plus 7.75% and a 1% standby fee, no break fee, meaning that we have optionality and flexibility to replace this financing packet, this debt package with a lower cost of capital. And there's also a cost contingency in the same shape and form as the gold stream. We just did a bought deal this week for about $83 million Canadian, and the purpose of it was to substitute the future use of the cost contingency. The project is located in the Golden Triangle. If you're not familiar with the area, it's known for very high-grade deposits. It's absolutely no coincidence that all of our majors are in close proximity. We are working alongside the Tahltan First Nation. They consider themselves to be a mining nation because of all of these amazing world-class projects and operations in close proximity. And being a past producer, we have significant cost savings in place. I will speak to the tailings facility that Barrick kindly permitted for us to save us $150 billion off the capex, as well as there is hydroelectric facilities 17 kilometers away from the mine that allow us to source electricity for 6 cents per kilowatt hour, whereas the comparison is other mines are paying 60 cents per kilowatt hour. So when you put it all together and you go, okay, the Skeena advantage is ultra high grade and a very low cost of power are the key contributors for being a significant cash flow generator. We put out a definitive feasibility study in late 2023 as well. At spot prices today, the NPV is north of $4 billion after tax, 67% IIR, and 0.7 years payback, meaning that once we get up and running, we will pay back the initial capital cost of the project in about 300 days based on the cash flow that we will be generating. So phenomenal economics. And again, I will draw your attention to the cash flow and the EBITDA, because when you look at valuations, you can apply a conservative multiple of, say, 5 times to your EBITDA of 1.3 billion, you get to a market cap of 6 billion. You can apply a conservative multiple of 8 to your cash flow, get to a market cap of 6 billion. So that gives you an idea in terms of how we think about valuation as compared to a market cap today of 1.5 billion, so a significant discount to what we should be worth. The production profile is front-loaded. We did that on purpose. The grade and the ounces are elevated in years 1 through 5. We know that we have opportunities in later years to backbolt satellite deposits to even out the profile in years 6, 7, and onwards. Right now, we are in the formal environmental assessment application phase. And the thing to note here is that a couple weeks ago, the government of BC put out an announcement that they were expediting 18 projects, 4 of which were mining, to offset the negative implications associated with the Trump tariffs. And within that announcement, SK Creek was top of the list. So it gives us and our shareholders confidence in the timelines that we've put out, knowing that we have bureaucrat support and government support to bring this project on stream. Just in terms of scale, to really appreciate how desirable this asset is, when you look at the highest grade open pit mines in the world, in years 1 through 5, we're second from the top, remarkable. And even life of mine, 3.6 grams per ton, we know we can get that number up. So truly a unique deposit. And in terms of size, there's 4.6 million ounces in reserves, 80% in the proven category. We know we're going to get that 4.6 number up higher as we incorporate value-add elements into the mine plan on the other side of the EA. But overall, a very desirable asset. Now, the reason why I'm talking on the silver panel is because the value split is 65% gold and 35% silver. But because of how big SK Creek is, that 35% byproduct credit on the silver actually makes it one of the largest primary silver mines in terms of annual production. So in years 1 through 5, we're going to be producing 9.5 million ounces of pure silver off the byproduct credit versus life of mine of 7.7. And if you love silver, if you know the silver space, you know that's a lot of silver, especially against a backdrop where there is a significant scarcity of silver-dominant asset. So 88 million ounces in silver reserves, again, is very, very meaningful. We love the silver story because it gives us an opportunity to further propel our re-ratings going forward. And it's also a very meaningful byproduct credit on our unit costs. So this slide is everything because it comes down to valuations. We get asked the question all the time, what are you worth? And it's actually very simple because there's not a lot of single asset companies that will be producing 450,000 ounces of gold equivalent metal. And so the one we can really look to is Lundin Gold with Fruta del Norte. They're a cash flow story, we're a cash flow story. We have similar operating parameters in terms of size and scale, and they're sitting at a market cap of about $10 billion Canadian. You can look at PNAVs at spot prices today, we're about 0.4. And we know with a world-class asset like this, as we get closer and closer to cash flow, which is about 2 years away, we can get to 1 times NAV on the gold, and we can get to 1.2 times NAV on the silver. So the upside opportunity that's ahead of us that's really compelling is 4-fold from where we are today. Very strong capital markets profile. We're 75% institutionally held. We've got new generalists entering the name just recently. For example, Helicon started speaking with them in September. Now they own north of 10% of the company. But all of our shareholders here are certainly in it for the long term, understanding the value of the asset. And the retail float is only 23%, meaning incremental amounts of inflow can have a dramatic impact on the share price. We've got 114 million shares out, which is very, very small. Disciplined equity management strategy. We have all the funding in place. And 11 banks on the Canadian side that follow the name. So tying it all up, I'd just like to say that I do encourage every Canadian to take a look at Skeena as a addition to the investment portfolio, given where we are today on the development timeline. It's just such an incredible opportunity, one, to make a profound impact in the province, in the country, and I think just joining us along for this journey as we build this project, the valuation that we have today is incredibly attractive at 0.4 times NAV. I'll leave it at that. Thank you so much.